Alright everybody, welcome back to Strongman Personal Finance. I'm your host Strongman, and today we're going to talk about fractional shares. Now you may be thinking, I don't have enough money to invest, Strongman. I only have $20 in my bank account. Most people don't have access to financial institutions and brokerages to actually start investing. Well, let me tell you what, you're freaking wrong. You can actually start investing with just $1. How? Well, you can buy into mutual funds, or you can buy fractional shares of stocks or exchange traded funds. Let me show you an example, okay? You see this? This is a share of Strongman stock. It is traded on the NASDAQ Composite. Do you see it? Each share of Strongman stock is $100. Well, how the hell are you going to buy a Strongman stock if you don't have $100? Well, let me tell you what. It's called fractional shares. Observe. This is a small fraction of Strongman stock. This is only $20. You can actually afford this now because you can buy a fraction of a stock. You don't have to buy the entire stock to own it. Does that make sense? Fractional shares are a revolution for investors. That's because the average investor who has no money can start investing into a diversified, broad swath of the market with just a couple dollars. Now, back in the day, you couldn't buy fractional shares. If you wanted to buy a share of stock, you had to buy the actual full share of stock on the exchange. For example, right now, Amazon stock is trading for $2,743, roughly. Back in the day, you would have to pay $2,743 to buy one share of Amazon stock. Now, you can literally take $10 and buy a fraction of an Amazon share. So you actually own a part of the company without owning an entire share of stock. That's pretty awesome. If you like this so far, please like this video and subscribe to my channel, okay? I'm trying to get rich and famous, and you're not helping me by not liking my videos and subscribing to my channel, okay? I need to attract advertisers, so that brings more money to me, and that allows me to share my amazing wealth knowledge to the rest of the world, okay? So smash the like button. Thanks. Back to the topic at hand. I don't recommend that you invest your entire portfolio in individual stocks. As a matter of fact, I think you should only have a very small portion of your portfolio in individual stocks, and that should be for speculative purposes only. However, I do think the best way to own a broadly diversified portfolio of individual stocks is to buy fractional shares. Now, what happens is if you don't buy fractional shares, you're going to have to buy the stock at its full price. And if you only have a couple $100, that's going to make you buy at most one or two stocks based on their current share price. With fractional shares, you can buy 10, 20, 30, 50, 100 stocks with just a couple $100. That's a pretty good deal. You're going to have to buy fractional shares through a brokerage firm. You can't buy a stock or a stock and a half from somebody individually and have them ship you a stock certificate and then another one that's ripped in half. You're going to have to buy it through a broker. You're not actually going to get any kind of certificate. There's plenty of brokers out there that offer fractional shares. These include Fidelity, M1 Finance, my favorite, Robinhood, and more. It takes a quick Google search and you can find plenty of brokerages that offer fractional shares. Now, overall, I think it's a good thing that people can buy fractional shares because it allows people to start investing young and with not that much money. However, like I've said repeatedly, the vast majority of your money should go into buying mutual funds, which you can also buy fractional shares of, or exchange traded funds that are well diversified. Just make sure if you buy ETFs, you don't freaking trade them. You buy them and you hold them for the long run, just like you do mutual funds. If you can't control yourself, don't buy ETFs, just buy mutual funds. And if you want to play around with a little bit of money, no more than 1 or 2% of your portfolio, then you can buy fractional shares through some of the apps that I mentioned previously. Okay, you may be wondering, how are fractional shares even created? Do people rip stock certificates in half and then hand them out to each other, just like I did with my strongman stock? No, they don't. And by the way, strongman stock doesn't actually exist if you actually thought it did, okay? Anyway, fractional shares are mostly created through stock splits. For example, you could have a 3-for-2 stock split, which means if you have 2 shares of stock, you can trade it in for 3 shares of stock. And you're not losing money, but basically the value of each stock goes down because you're getting more shares of stock. For example, let's say you have 3 shares of stock and there's a 3-for-2 stock split. Well, you're going to turn in 3 shares and you're going to get 4.5 shares in return. It's a 3-for-2 stock split. It's a ratio. You basically get 1.5% of how many shares that you had originally. So in that case, you've just created a fractional share. 3 stocks became 4.5 stocks. 5 stocks become 7.5 stocks. It's a 3-4-2 share split. You can also create fractional shares through dividend reinvestment programs. Now, as I've explained previously, companies will pay out a part of their profit to their shareholders. That's called a dividend. And if you think about it, why would anybody want to buy a share of a company if the company was never going to pay out any sort of profits to the shareholders? They probably wouldn't, okay? These companies will pay out dividends every year. It could be 1% of the stock's share value, it could be 2%, 3%, whatever it is. If you think about it, if you have a stock that's $100 per share, and this stock pays out a 3% annual dividend, there's actually a way where you can tell the company that you want to reinvest the dividend back into the company instead of taking out the cash payment. In that case, that's called a dividend reinvestment program. So if a $100 stock pays out a 3% dividend, it's going to pay out $3 in dividends. If you reinvest that $3, you have 1 share of stock for $100 plus that additional $3. So you really have 1.03 shares of that stock. That's a fractional share. Now, the way brokerages do it is, let's say you want to buy 1.5 shares of a stock, okay, for $150. Each share is $100. What the brokerage will do, like M1 Finance or Robinhood or whatever, is you'll say, I want to buy 1.5 shares of stock. They'll go out on the market and they'll purchase 2 shares of the stock and they'll credit that 1.5 shares to your account and then keep that half share in their inventory. So really, the stock was never actually split in half. Like the piece of paper or the stock certificate wasn't split in half. But in the accounting, the company went and bought 2 shares of the stock and then they credited 1.5 shares to your account. Now, if you wanted to sell those 1.5 shares in the future, what the brokerage firm can do is they can take your order for, let's say, 1.5 shares, and then somebody else who has an order to sell for 1.5 shares, they bundle that together, that's 3 shares, and they sell that in the market. Then you get that cash, and it's split equally between the 2 of you. Does that make sense? Now, in conclusion, fractional shares are pretty cool. Like I've said a couple times, you should only spend, a small percentage of your portfolio investing into individual stocks. But when you do so, you can use fractional shares to build a broadly diversified individual stock portfolio. When you do it, don't make it a big part of your portfolio. You should invest the majority of your money into mutual funds or ETFs that you're not going to sell, okay? But if you want to look into fractional shares and you don't have much money, that's the way to do it, okay? If you like this video, hit like, subscribe, and hit the bell button for notification. You have a wonderful, delicious day.